What's up, guys? It is the 9th of February. Another Friday's come upon us. I got Patrick McCarrol back in here because we're getting into the depth of stuff to understand what's going on in the background. I need that some bitch because he's got some shit going on in here I don't quite possess yet. So thanks, brother. I appreciate you jumping back on with us. And this is gonna be a regular thing, right?
Yep. Yep. We're in it. We're together on this deal now.
Until such time that I'm offending him enough that he can't take it anymore.
It's not going to happen.
So I'll just wait and see the hate mail that comes in. Say, dude, you can't talk shit like that. And then eventually he's just not going to show up. You're just going to see a background.
Not going to happen, brother.
So how's the last couple of weeks been?
It's been interesting, watching this fluctuation. It's watching what you and I have talked about, for several months now, which is this, tug of war battle between market expectations, projections, where the market thinks everything's going to go, and then what the Fed is actually talking about, and then this, idea of when are cuts going to begin, right? At what point are they going to begin? I think we've already punched the March opportunity out of the way, which has caused interest rates to pop up a little bit, as you and I have discussed. Now May is starting to dwindle quite a bit. We've fallen from a 56% probability to 52 yesterday. I haven't quite checked it today, but it's interesting to watch that dynamic play out.
It seems as though, and this is just Aaron Chapman's summation, right? So just so you guys know, what you got two different guys on here, right? One very educated and bearded redneck. So what we've got here, and not to shut on educated people whatsoever. What I found over my career is when you go and you get the education and stuff, you are being given the glossary, being given the definitions of all these things that are trying to make complicated. When in reality, the market's not that damn complicated. It's a language that we don't understand that references how people feel about a certain thing, whether they want it or they don't want it. That's the market. It's what do people want to put their money into, what do they not want to put their money in? What do they believe and feel like is going to make a return and what's not? Then you have manipulation. And what we're talking about here, and Patrick has been one has the background to be able to understand the glossary better than me. I'm having to learn it as I go, where he had somebody pounded into him the glossary and the definition and terms and all these things to understand it and be able to peel through it faster than I've been able to over the years. But what you have here now is we're talking about manipulation. We're talking about headline numbers coming out to get the market to react and make people feel good about a certain direction versus where they really should be going with their money or where the market goes with their money. Now, one of the things we're dealing with right now, everybody wants to talk about interest rates. What drives interest rates? Interest rates are driven by supply and demand of money in the mortgage-backed securities. And we look at those charts, we'll look at those charts again. There's a lot of reasons why those rates will go down, or money will flow into those pools of funds, or the market will decide, yes, let's put money over there, or let's take money out of it. Now, as we both understand this, Patrick, is the more the economy is harmed, or the inflation is more under control, or if people are depending upon what's going on in the market, it's going to dictate whether or not somebody wants to put their money in a long-term bond, like a mortgage-backed security, and let it sit there and grow slowly, or they're going to put it into the equities, which might grow faster because we have more of a robust economy. Is that correct?
It kind of really is more simple than that. It's more of a layer of risk versus non-risk, right? Where can we put risk in risky situations? Where is risk less risky, so to say? Where is risk more expensive? Where is it least expensive? So you see this flight to safety and or transition to risk a lot, right? So if the stock market's doing really bad, the yield and rate of return is negative on that side, you'll see a flight to safety into bonds to really have a safer place that's not as volatile, right? And then as things improve, you see that money transition back into risk. So the term is risk on versus risk off. That's what you hear a lot on CNBC and other financial platforms.
So if we look back this last week, I'm going to go to share screen. There's a lot of people that tell me, oh, I heard rates went down. Like, no, we've actually seen rates jump. I actually had a conversation with some folks this last week telling me that what I was showing them as a cost for a certain rate was 2% higher than what somebody else claimed. When I'm like, I have no idea what this person's doing claiming this, but they claimed this on Friday. So our Friday, I'm going to zoom in a little bit more on this. This was Friday.
Yeah.
You know, this was our Thursday. We closed. We hit this line that I've been talking about, and I'll keep talking about, the price point established back in 2008 from the day they announced quantitative easing. We hit it on Thursday. Friday we opened up and we took a massive beating. Well, this individual was making this quote Friday morning. I think that they were thinking we were going to bounce off this and turn around, which we did not. But so what happened on Friday?
Non-farm payroll report. So the market was, anticipating, I think the number was 180,000 new jobs created for the month of December. I think we ended up with 353,000 jobs created. So the way you look at this is obviously that's a kind of a risk off type scenario, because the more people who are employed, the more people who are earning a wage, that wage is then transitioning into the marketplace, which is then creating inflationary pressure. So employment numbers are actually fairly vital towards fixed rate investments.
So with that, I mean, and then how real do you think that data was that we received?
So there are a lot of rumors. There's a lot of talk in the idea, because what made the labor market complicated was the post-COVID transition, right? So the ability to be a DoorDash driver, the ability to be one of these firms that goes and picks up your groceries and delivers to your house. So there are some professors that are out there that study this data quite a bit that believe that the part-time employment is actually making the jobs numbers look more aggressive in regards to the idea that not only are people employed on a full-time basis, but then they're going and working the 34 hours in a DoorDash type setup because they're having struggles making ends meet. So along with that employment report was the average hours worked, and that fell to 34.1. So if you think about it, we used to believe full-time was always this 40-hour work week. And now we're kind of celebrating this 34.1 hours worked within a week. And you can easily go get a part-time job and get that 34 hours to make it considered another full-time job. Which, oh, by the way, that 34.1 hours is the lowest number of hours worked since 2008. So there's a bit of an attachment there, but that is the piece that people are waving the flag going, hey, this doesn't make sense, because 34 hours is really considered part-time, and that this part-time surge is manipulating the report.
Factor in, I've seen this statistic. If you factor in the hours not worked and factor into how many full-time jobs, 40-hour work weeks, even 30, if we want to do this 34-hour work week thing, that we would count, it'd actually be a bigger loss. So 40-hour work weeks that were lost due to that cut in hours was over 2 million jobs, would take 2 million jobs off the market. But if you factor that, if 34 is now like the standard, if you will, based upon the people who are trying to push this data out, that's probably another 500,000 plus jobs. Think about this, guys. Think about the fact that they're trying to celebrate actual less hours worked. Therefore, when they get to this point to say jobs are going higher, it's because they're manipulating statistics. No different than what would they do with inflation. They use CPI and PCE. These two metrics, they will determine what they put into that index. It's no different than the Dow, the NYSE, and the NASDAQ being three indexes, but all have three different values because there are different things in them. The actual rate of inflation versus the CPI is vastly different, because what they measure and what we actually spend money on are two different things. So going back to the chart real quick from what you're describing, so everybody understands this, where it opened up Friday and the jobs report impacted, and then we get to Monday where the continued movement was, that's over 100 basis points in movement from close to close, not in the total swings. Total swings, you're probably about another, what is that, another 100, another 20, 25. Yeah. That full swing that day for those 2 days would be enough to have influenced the price of a rate. Whatever rate you were quoted on Thursday would cost you 1.25 points more. So for every $100,000, it was $1,250 more for every $100,000 in loan amount to get the same rate. So for the individuals out there that are trying to say things, they're literally rolling dice and praying that you're hanging on for them to walk and it come back. But I don't know that it's going to come back. I'm not convinced that we're going to see anything get above that 100.53 going forward. Now, Patrick and I might agree or disagree on that particular one. We don't talk about that particular fact much because I think I'm the only bachelor out there talking about it. But that thing right there, I think that we are seeing, and I want your opinion on this. We're seeing the lowest rates we're going to see for the foreseeable future, even if they lower rates. Because this, I'm going to throw this out here first before we get into your opinion on it. Let's go into, let me see here, 6 months on this whole thing. I wish my screen would actually show the whole freaking screen, not me having to scroll around on it. But
Yep.
for the next 6 months, we're not going to see another cut for probably another what? If they do cut, it's going to be 5 months from now, maybe 6 if
September.
they cut.
Yeah. I mean, you could get a lucky just we're gonna initiate June just to say we're starting that process to go from this QT setup to kind of a bit of easing from tightening to easing. But the hardest piece to this is that I don't know that they can, okay? Because and what I'm saying by that is I think if you get rates falling to 5, anything that starts with a 5, you've got housing bubble 3.0. And I think they realize and observe that, meaning you're going all the way back to 2020. This pent up demand is going to jump into the marketplace. There's not enough inventory that's going to be there. And as a result of, you would have competitive bidding. You would have another large percentage of people paying over. I know that they observe that. I think they realize that. So we're going to play this dance back and forth a little bit on seeing rates moving from 6.25% to 7%, kind of back and forth until they have no choice.
Great. So what I think is going to happen is just my own estimation. Let's say we are looking like a June or a July for an actual rate cut. Where do we start when that rate cut hits, guys? Look where we are. We hit this point that I keep talking about, and I'll keep talking about 105.3. Well, we got the jobs part pushed us down in here. We bounced along. I drew a line here at 99.33. We bounced a few days. Now we broke below it. We're below 99.33. We're heading down here to this other support at 98.89. So we're going to hit down here. Now, I like the 5.5 because I do a lot of stuff that it requires I look at the 5.5 a lot. But if we keep bouncing in here, let's say we spend time down in this and maybe even get below it, we could be down in this 98 area, 98 plus at the time that June happens when they start talking about it. And if they say, okay, we're going to cut rates a quarter, where do we end up? About where we're at now. So if that's where we go, and if all we do is if everybody holds out for rates to get cut, it only gets cut to bet us to where we are now. Why are you not locking now? I don't think that we have anything that's going to push us to this point above the 105.3, better rates than what we've seen already, because we have to have significant quantitative easing, not just we're going to cut back on rates. We're going to take the money that we had invested in the mortgage-backed securities. We need to start taking some of the returns, reinvesting it, and we need to start expanding the purchasing of the mortgage-backed securities, not just easing up on the rates for the overnight rate. So, any final thoughts on that?
Yeah, no, I have listened to Powell on multiple occurrences. Powell has been very adamant to one very key point that he states that the Fed will not participate in QE ever again, unless circumstances are leading into a depressionary type environment, meaning they have absolutely no choice. But I think they've learned their lesson on this QE manipulation and how difficult it is to repackage the box, so to say. So I don't know that you'll really ever see a QE again unless conditions are just dire, just absolutely dire.
This is what QE looks like, guys. This is what QE started. QE started here at the line we talk about.
Yep.
This is where they announced it. This is where they started it, an actual Fed involvement in it, and it continued all the way to here. All that, nearly 13 years of money being thrown into the market. They tried to pull away from it in 18. They had to get back in it because our market wasn't ready for it. They had what they called the taper tantrum, but that's what that is. Anything below that is what our market looked like for decades before. So don't get to thinking we're going to see those rates again. If for some reason we do, just know that you're not going to be able to afford the house that's going to be available to you. And the other thing is right now, guys, the hedge funds are taking it all. They took 44% of the sales last year. They're going to control 60+% of it by 2030. If you don't get on board now and start buying houses now and start filling up your inventory, you're never going to have a shot at it. I'm sorry, but they're going to take it. And the other risk, I think, of anybody putting money into the mortgage-backed securities to get it lower is what's the real value of the underlying asset? We have had housing pushed so fast, so high above what the real cost of sticks and bricks are that anybody who has a lien on that and is carrying the mortgage on that, I don't doubt there's some questions in their mind is what the real value of the underlying asset or what have got money tied up into. If it gets pushed higher, nobody's going to put their money into mortgage-backed securities. Nobody's going to risk that. And the only people that will own it will be the hedge funds, and they'll get to dictate the value of that asset. They'll get to dictate what you pay on a monthly basis to get it. You better start controlling the assets as fast as you can. Final
I
thoughts?
agree. I mean, I believe that the fabric of housing has changed. It's changed significantly. You keep hearing my agent partners and my friends that everybody keeps talking and discussing this idea of this return to normal, right? And I don't believe that we're going to see any kind of a housing condition previous to COVID ever again. Like, meaning I don't know that it's ever going to look like that again. We've got too many people that are in affordable mortgages. Prices have gone too high. What we're seeing now in regards to people who are listing properties and moving on are families that have had an increase in family size, a job relocation, desperately trying to get to a different school. So you're seeing needs that are dictating wants, right? So in the previous years of real estate, I just wanted a better kitchen. I wanted a better bathroom, but the step up in order to go from one to the next wasn't as nearly as aggressive. And because it's so aggressive, those wants have been completely suppressed and are only being filled by needs, right? And as long as that continues to play out, real estate's it's going to be a different fabric.
Well, I appreciate you taking the time jumping on with us. We'll see you again in a couple weeks, guys. Appreciate you watching, appreciate you subscribing, appreciate you forwarding. If there's anything you want us to touch on, I got the wizard behind the curtain now. You don't just have the smoke mirrors and bullshit. You got the guy that can pull it all out and throw it all out there for you. So
You got a really smart guy in you, though.
Well, I appreciate you, brother. Thank you.
All right, have a great day.
Take care.